Good evening, everybody, and we are going to continue um, with the readings from the Lord of Easy Money. And thank you for tuning into the channel, The Millennial Messiah. And as you know, um, personally, I believe that gaining as much intelligence as possible is part of the process of becoming like our Heavenly Father. And especially, we have been given stewardship over finances because it is something that we, unfortunately, in this world all um, use in order to live. And so, gaining as much knowledge as we can about finances and money and about how the government manipulates our currency will ultimately best aid us in making better financial decisions as a whole. So we're going to continue with reading from chapter 15, Winners and Losers, 2020. Stephen Munich was quick and to the point that he had personally recommended Jay Powell as the next Fed chairman. When President Trump was reviewing candidates, such a recommendation went a long way in the Trump administration. A good word from someone like Munich would be decisive in Trump's decision making. Munich was one of the few cabinet secretaries who served through Trump's full administration. While Trump had been impressed by Janet Yellen, Munich had a stronger bond with Jay Powell. Both men had a long background in the world of private equity and leveraged loans. They spoke the same vocabulary of banking and deal making, and had a shared sensibility about the world. After Powell got the job, Munich and Powell had lunch at least once a week. Munich liked Powell, also had a granular understanding of markets and trading. He got his professional start at Goldman Sachs, where his father had been an influential partner. After 9 years at the firm, Munich also made partner. He left Goldman in 2002 with the company stock worth about 46 million. Munich then joined a private equity fund called ESL Investments, then started his own hedge fund called Dunn Capital. Munich made a killing after the housing market crash of 2008 when he organized a group of investors, including Michael Dell, the founder of the computer company, and George Soros. They bought a failed bank in California called IndyMac, which had been a major provider of failed home loans. They renamed the company One West and went on a home foreclosure spree, eventually selling the bank for 3.4 billion in 2015. Munich knew how to manage sensitive situations and how to deal with problematic investors and clients. He also had a pre-natural attorney ability to blend into the background of the Trump administration, while also retaining influence. Munich could do this in part because he excelled at doing what Trump hated doing most, which was getting involved in the details. When the coronavirus pandemic crushed the American economy, it was Munich, not Donald Trump, who took the lead role in negotiating with Congress on behalf of the White House. This was a delicate job since the House was controlled at that time by the Democrats and the Senate controlled by the Republicans. Munich talked frequently with Nancy Pelosi, the Democratic Speaker of the House, building a bridge between the White House and the opposition party. Congress had become a graveyard of ideas, ambition, and public purpose during the administration of Donald Trump. After passing the tax cut and a major criminal justice reform law, Congress had done little else. Senate Majority Leader Mitch McConnell focused most of his energy on appointing federal judges, which required only a bare majority of Republican votes. Nobody had big hopes for Congress when it came time to address the pandemic. Trump encouraged Congress to pass some kind of relief bill without offering much in the way of guidance or support. Trump spent hours of his day performing manic monologues in front of the television cameras. By March 18th, Congress had passed two relief bills totaling roughly $230 billion, which were wholly inadequate for the problem. A familiar rhythm developed in which promising signs of action would dissipate as soon as any plans for action moved to the poisonous atmosphere of the Senate, where McConnell helped suffocate them. This left America to depend upon, yet again, the Federal Reserve. But the Fed could not act alone if it was going to do the things that Powell was considering. During this period of March, Munich and Powell talked on the phone roughly 20 times a day. There was a legal reason that Powell needed to talk with the Treasury Secretary. Congress had limited the Fed's emergency powers after the crash of 2008, when the Fed extended loans that were arranged quickly and with little oversight. When Congress passed the Dodd-Frank Reform Law of 2010, it included new restrictions on the Fed that required the bank to get approval from the U.S. Department of the Treasury for emergency actions that were not spelled out in the Fed's charter. When Congress created the Fed in 1913, lawmakers were cautious in defining the scope of the central bank's power. They were just as careful in setting strict limits on what the bank could not do as they were in defining what it could do. The Fed was denied the power to lend directly to corporations or to take on risky debt like leveraged loans. This was designed in part so the Fed could not pick winners and losers in the economy by directly subsidizing some industries over the others. The Fed arguably went outside of this structure in 2008 when it arranged loans for failing investment firms like Bear Stearns. But Dodd-Frank gave the Treasury Secretary clear oversight over such actions. This is why Powell had a copy of Dodd-Frank on his desk when he started working from home in March. Over the weekend of March 20th, he finalized the details on a complex rescue package that would include several interlocking bailouts, each targeting different parts of the financial system. This would be the largest, most far-reaching, and most consequential intervention in the history of the Federal Reserve. It could change the central bank's role in the American economy for at least decades to come, and dramatically increase the Fed's financial footprint. The package was arranged during phone calls between Powell and Munich, Fed governors, and senior Fed staff members. Unlike formal FOMC meetings, these conversations were private and not transcribed for the public to review. Side note, I think that's totally dishonest, but unfortunately we live in a government that, nowadays all the governments of the world are dishonest, so there's not really anything new to there. But let's get back to it. The full FOMC did not vote on the program once it was finalized. Because the program was an emergency lending effort, it only required the approval of a handful of members on the Board of Governors. One participant in these discussions described the process as being the opposite of creative. The Fed wasn't trying to do anything innovative or novel. It was just figuring out which corners of the financial world were engulfed in flames, and then pointing to the Fed's flood of new money that it in that direction. The Fed decided to resurrect a certain legal tool that it pioneered during the 2008 financial crisis called a Specialist Purpose Vehicle, or SPV. An SPV was basically a shell company that allowed the Fed to get around the limits placed on its lending authority using the U.S. Department of the Treasury as a partner. Many of the phone calls in March were between the Fed's lawyers in Washington and the Fed's financial team in New York City, which would create the new SPVs. Each SPV was basically a company, formally formed jointly between the Fed and the Treasury Department. The company was registered in the state of Delaware at a cost of about $10. The state Treasury Department would invest taxpayer cash in each SPV, and then the Fed would use that cash as seed money to start making loans, lending as much as $10 for every dollar invested by the Treasury. This taxpayer money is what allowed the Fed to go outside its usual limits and start buying risky debt and extending loans to new parts of the economy. If there were any losses, the losses would be paid for first by the taxpayers, which helped make the Fed make the legal argument that it was not in fact making risky loans. Powell would cite this fact as a justification for the programs. The Fed might be taking on more risk and expanding its missions, but the Treasury Department had oversight over the whole thing, which meant that there was some level of democratic oversight. The Fed created 3 important SPVs by the end of that weekend. The first 2 SPVs would allow the Fed to buy corporate debt. The motivation behind this was obvious. The Fed saw what was coming in the chains of failures as corporations defaulted on their loans, damaging the banks and hollowing out the value of CLOs. To prevent this calamity, the Fed expanded the Fed put into an entirely new area of finance. The people who traded stocks now assumed that the Fed would step in with a rescue package if the stock market ever crashed. Now people who traded corporate bonds and leveraged loans would have the same reassurance. This had consequences that reverberated far beyond the corporate debt trading desks. The interest rates on corporate debt were supposed to measure the underlying risks of that debt. Risky companies had to pay very high interest rates, while safe companies paid low interest rates. Now that the Fed had stepped in and become a majority buyer of corporate debt, providing a floor for the market, it changed the very nature of interest rates on the debt. Those rates didn't just reflect the risk of the company, but it also reflected the Fed's appetite to buy the bond. Critically, once the Fed bought corporate bonds, it could never undo the action. The eager eyes on Wall Street would always remember what they had seen. Every time the Fed intervened, its future intervention was assumed. Perhaps the most groundbreaking SPV was the third one, which would buy debt of mid-sized businesses that were too small to get leveraged loans or corporate bonds. This program was wildly experimental. The Fed lawyers who constructed it only had the broad outlines in place when the program was announced. They planned to fill in the details later. The guiding principle of the program was that it would move the Fed's reach beyond the confines of Wall Street. Instead of using the primary dealers to implement this plan, the Fed would use regional banks as its conduit. The banks would give loans to small businesses, and the Fed would buy 95% of the loan, letting the regional bank hold the remainder. The Fed called this program the Main Street Lending Program. The final piece of the rescue plan was not a new SPV, but a massive influx of money in the form of a large-scale, near-permanent quantitative easing program. The parameters of this new round of QE would be left intentionally vague. The Fed would create as much money as it decided was necessary, for as long as it was needed. The scale was unprecedented. In 1 week, the Fed bought $625 billion in bonds, more than it purchased during the entire program that Tom Hoenig voted against. By Sunday evening, March 22nd, the plan was largely pulled together. But there was one small problem. The plan called for the Treasury Department to invest about $454 billion into the new SPVs, which would enable the Fed to loan about $4 trillion in new debt. But Congress had not yet passed a relief bill that would authorize the use of $454 billion of taxpayer money. Powell and his team decided they would not wait on Congress. They would announce the new SPVs on Monday morning, March 23rd, before the markets opened. The Fed's announcement on that morning was radical, and it was enough to stop the panic. In roughly 90 days, the Fed would create $3 trillion. That was as much money as the Fed would have printed in roughly 300 years at its normal pace before the 2008 financial crisis. There was virtually no public opposition to the Fed's actions, and Powell expanded the Fed's efforts. Within less than 3 weeks of its rescue package, the Fed announced new actions that built on what it had already done. Once again, the plan was not voted upon by the full FOMIC, and there are no transcripts available to determine the thinking behind the new initiatives, parts of which were approved by a unanimous ununanimous closed-door vote on April 8th. The Fed announced on April 9th that it wouldn't only buy corporate bonds, it would also buy even riskier bonds, which were rated as junk debt. The vote was taken by Powell, his vice chairman Richard Claridia, and the governors Randall Quarles, Lael Brainerd, and Michelle Bowman. The junk bond purchases would not be unlimited. The Fed would only buy debt that had been rated as investment grade before the pandemic. These bonds were called fallen angels on Wall Street, and they included debt from companies like Ford Motor Company. By purchasing the debt of fallen angels, the Fed was also helping out the much larger pools of even riskier corporate junk, such as Rexnord's, that already existed. When the debt of the fallen angels crashed down the rating scales, it would displace these other loans and make them far less attractive to purchase. The Fed had stopped this potential cascade. Also that day, the Fed updated a separate new program called TALF, for Term Assessed Backed Securities Loans Facility. so that it could be directly purchased for the first time. Big chunks of CLO debt, which was composed of leveraged loans. This was a significant extension of the Fed's safety net, and it played a large role in the quelling the anxiety around the hundreds of billions of dollars worth of CLOs that faced loan write downs and breaches of their standard caps. It also helped the big banks that owned billions in CLO debt. All of this barely penetrated the public conversation or the cable news landscape. Yeah, isn't that funny? Just this is just a side note how the news really doesn't actually cover anything when it comes to the Fed. Like you hear about it briefly, but they don't actually take the time to actually talk about what they're doing when they're manipulating the value of our currency, which I think is really messed up and really sad. But anyways, let's go back to it. This was a significant extension of the Fed's safety net, and it played a large role in quelling the anxiety around the hundreds of billions of dollars worth of CLOs that faced loan write downs and the breaches of their standard caps. It also helped the big banks that owned billions in CLO debt. All of this barely penetrated the public conversation or the cable news landscape. The reasons were predictable. Everything was cloaked in language that was obtuse and incomprehensible. As the Fed put it, the SMCCF was amended and expanded, while the TALF added a new asset class to support the flow of credit to households and to businesses. Not thrilling stuff. And even less compelling on a day when 35,000 new coronavirus cases were reported compared to 201 on the same day of the preceding month. And states were closing down restaurants and stores left and right. But to people who actually traded bonds and who packaged and sold them, the news was shocking. It was one of those things that divided history. There was the way things worked before the SPVs were created and the way that things would work afterward. The secondary market corporate credit facility, as the Fed called one of its corporate bond buying programs. Fundamentally, we have now socialized credit risk, and we have forever changed the nature of how our economy functions, said Scott Minerd, the Fed advisor and a senior trader at Guggenheim Investments. The Fed had made it clear that prudent investing will not be tolerated. Just the announcement of the Fed's program was enough to soothe the bond dealers and the CLO operators. The Fed bought only a tiny fraction of available corporate bonds, not nearly enough to prop up the entire market, but it had telegraphed that it would be there if the trouble resumed, and its pocketbook was bottomless. This was evidence of the program's success in the eyes of its creator. Stephen Munich at the Treasury was particularly pleased. The day we jointly announced that transaction and the commitment to it, that unlocked the entire corporate bond market, Munich later said. These actions, as dynamic as they were, directly benefited only a small group of people, those who owned assets and those who made a living trading them. But the financial crisis the Fed was fighting was a different thing than the much broader crisis of the coronavirus pandemic. The virus was infecting and inflicting incalculable damage across American society in areas the Fed could not address. The hospital system was overwhelmed. Emergency room nurses wore improvised protective gear made out of garbage bags. The virus spread more quickly because many workers who got sick did not have paid sick leave, so they stayed on the job and infected others. State governors had to compete with one another to obtain necessary supplies such as viral testing kits. Governor Larry Hogan of Maryland smuggled a plane load of test kits from South Korea, which were kept under armed guard when they arrived. Restaurants, theaters, stores, and schools had closed down in order to slow down the infection. But while they were closed, the federal government failed entirely to implement any kind of unified response to the virus. This failure left businesses and schools with a terrible choice in that late spring. They could either reopen with the pandemic worse than ever before or remain shut. During this period, roughly 22 million American jobs disappeared, creating the worst job crisis since the Great Depression. The central bank could not address these things, and for many years, central bank leaders had not complained, had complained that their counterparts in Congress did not do enough to address the many deep problems that afflicted the economy. Jay Powell had echoed these thoughts and had launched key parts of the March rescue package without waiting for Congress. Which, side note, I personally believe that that's illegal what he did because he did it without the approval of Congress, and Congress ultimately is the one that's supposed to have the power to do all this stuff. But apparently in our day and our world now, it just doesn't matter, which is kind of sad to think about. But anyways, back to it. It says, but just days after the Fed's groundbreaking SPVs were announced, Congress would step into the breach. It would pass one of the largest, most expensive bills in modern history, called the CARES Act, which is funny because they don't actually care. This was the chance for Munich, Trump, Pelosi, and McConnell to show that they could solve big problems, and that the United States government could lend a hand when it was needed. The CARES Act authorized $2 trillion in spending to counteract the pandemic, including $454 billion in taxpayer money to fund the Fed's SPVs. The part of the CARES Act that got the most attention was the roughly $292 billion chunk of the spending that went directly to the people. There was a good reason for this spending to get the attention that it did. The impact was immediate and beneficial for the millions of people who received it, and the government had never truly done something like this before, sending direct payments to people regardless of their previous level of tax payments or even of their current level of need. These direct benefits were coupled with more benefits for those who had been directly affected by the lockdowns. Unemployment insurance benefits administered by the states were boosted by $600 a week through July. That benefit was particularly extended that summer, although at a lower level. The spending that went straight into people's bank accounts was the most visible part of the CARES Act, but it was a relatively small part of the overall relief spending approved by Congress, which included the CARES Act and 3 smaller bills. Over half of all that money was aimed at businesses, according to an analysis by the Washington Post based on data from the Committee for a Responsible Federal Budget. A vanishingly small share of the $4 trillion was allocated to address the public health crisis created by the pandemic. or to slow the virus's spread. The largest chunk of the money, totaling $670 billion, funded an emergency loan program called the Paycheck Protection Program, or PPP. The idea was that the businesses would get a PPP loan, keep their employees, and then the loan would be forgiven when the businesses reopened and everyone went back to work. This money could have potentially helped a huge and diverse population of business owners who had suffered terribly during the long and punishing lockdowns, and it did help millions of businesses. But more than half of all the PPP money went into just 5% of the companies that received the loan. Even that figure understated the narrowness of the impact. Fully 25% of all the PPP went to 1% of all companies. These were the big law firms and national food chains, which got the maximum PPP amount of $10 million. Those beneficiaries included the Boston Market restaurant chain and the high-powered law firms of Boise, Schilder, and Flexner. An analysis by the Federal Reserve and others found that the PPP program saved about 2.3 million jobs at a cost of $286,000 per job. After President Trump claimed it would save or support 50 million jobs. About 651 billion of the CARES Act was in the form of tax breaks for businesses, which were often complicated to obtain. This meant that the tax benefits went largely to the big companies that could hire the best tax lawyers. The Cheesecake Factory restaurant chain, for example, claimed a tax break of 50 million, even as it furloughed 41,000 people. See, honestly, this is just another side note. That's messed up. They literally let go and fired 41,000 people, but we're still given a 50 million tax break. If I wasn't, that's just so messed up. Honestly, I don't think they should have given them that 50 million, especially because they let go of 41,000 people. That's just outrageous. But anyways, back to it. About 250 billion of the tax breaks were given to any business in any industry without regard to how much they might have been hurt by the pandemic. People who owned businesses were given tax breaks worth 135 billion, meaning that about 43,000 people who earned more than $1 million a year each got a benefit worth 1.6 million. By and large, these billions of dollars were quietly absorbed into corporate treasuries and personal bank accounts across the country. The wildly unequal distribution of the money was not made public until months later, after the Washington Post won an open records lawsuit that made the information public. The unequal distribution of federal aid from both Congress and the Federal Reserve exposed the underlying structure of the American economic system in 2020. As the dollars flowed through the nation's financial plumbing, they illuminated which parts of that system worked quite well and which did not. That system the Fed used to deliver money to the primary dealers, for example, worked with the speed, smoothness, and efficiency of a hyper-modern and well-maintained network. The money for everyone else migrated through a neglected, leaky network that failed to deliver the relief that was advertised. One reason the PPP loans failed was to make their way to small businesses in need was that the loans were processed through the Small Business Administration, which was supposed to work with participating banks. The SBA was a sleepy agency that had never administered an emergency program of this scale. Not surprisingly, the companies that fared the best in this system were the companies that could navigate a complex and overwhelmed bureaucracy. Inside the Trump administration, the intervention was seen as a success. Steve Munich, for one, wanted to get the emergency money out the door quickly, even if some of it went to companies or people that might not need it. He didn't want the ideally perfect program to be the enemy of the realistically good one. Munich knew that some of the money was misdirected. He publicly chastised the Los Angeles Lakers for taking a $4 million loan, calling it outrageous. But Munich believed the rapid response, combining the fiscal spending with the monetary stimulus, was the only thing that staved off a worse disaster. Never in the history of the Fed has there been coordinated action with the Treasury and the Fed the way there was in March and in April of that year. Nothing in the financial crisis comes even close to this, Munich later recalled. I think if we had collectively not done what we had done, certain actions we did together, and certain actions the Fed did independently, I think we would have had a Great Depression. I mean, with the prices that everything is going through now, when you compare it to the Great Depression, I would say we're in a Great Depression right now in terms of our buying power. Like every day it seems like you can go to the grocery store and it's more and more expensive. Like, this is a total side note, but like for me, I buy the same groceries every week, and just in the last month my grocery bill went up by $20 just for the same exact stuff. So anyways, back to the reading. There was a growing sensitivity inside the Federal Reserve about the central bank's public image. Jay Powell led an effort to portray the bank as a vehicle to help the middle class. In 2019, before the pandemic, Powell had gone on a listening tour to hear the concerns and the ideas of the working people and to discuss how the bank might help them. There was a strategic reason for this. Senior leaders at the Fed knew that it was unpopular to help the very rich while everyone else languished. Everyone else is still languishing. The Fed's bailouts in 2008 and 2009 played a formative role in animating both the Tea Party movement on the right and the Occupy Wall Street movement on the left. The conservative backlash was particularly intense and led to strident calls for the Fed to be audited. Which, by the way, side note again, I 100% agree. They should be audited, but whatever. More tightly regulated or even disbanded altogether. That I totally agree with. I think it should be disbanded altogether, and I believe we should go back, to the gold standard. But is it going to happen? Probably not, but back to it. This was recognized by those who participated in the Fed's internal lessons learned session, including the former senior economist Claudia Sham. The Fed always gets slammed because it's easy. No one understands what the heck they are. They seem like they care about Wall Street, so they will get hit, Sam said. After the Fed announced its new programs in late March, Saham and others were worried about the backlash. I mean, the end of the Fed movement in 4 years. I don't even want to think about what it looks like, she said. I think we would do just fine without the Fed, personally. If we just went back to the gold standard and didn't have to deal with the Fed devaluing our currency all the time, I think we would be better off. Anyways, back to it. It was difficult to argue that buying junk bonds and CLOs would help a Starbucks barista who was out of a job. But the Fed did have one program that it could point out to when it made the case that it was working hard to help people outside of Wall Street. This was the Main Street Lending Program. The program was kind of like checks sent to people under the CARES Act. It got a lot of attention. It was new and even shocking to the people who followed the history of the Fed. It would push the Fed into the terrain of giving credit directly to companies that could tap the bond market all across America. The Fed was breaking barriers and expanding its reach. Yeah, that's for sure. Like a hydra. More heads expanding further. Not good. And was doing it all to help small businesses. Well, that's what they say. The Main Street program allowed the Fed to argue that it wasn't just bailing out asset owners and hedge funds and Wall Street banks. In April, the conservative and influential economist Glenn Hubbard told the Wall Street Journal that the success of the Main Street program was important. It would show that the Fed could use its creative energies to help people outside of Wall Street. That's funny. The Fed being creative, that's like the biggest joke in the world. But the Main Street program allowed the Fed to argue that it wasn't just bailing out asset owners and hedge funds and Wall Street banks. In April, the conservative. Wait a second. I did read. Okay. The conservative and influential economist Glenn Hubbard told the Wall Street Journal that the success of the Main Street program was important. It would show that the Fed could use its creative energies to help people outside of Wall Street. I'm really worried it's not going to work, Hubbard told the newspaper. And of course, it did not work. The Main Street program was unwildly complicated and difficult to use. It relied on local and regional banks to first make loans to small businesses, which the Fed would then buy, but the Fed would also insist that the local banks keep 5% of the loan value, meaning the banks had to absorb some of the risk. The banks were also deterred by the expense and work entailed with making loans to so many companies that it might be in dire straits. With little chances of survival, the Main Street program had been built to purchase as much as $600 billion in loans. It had purchased a little more than $17 billion in loans in December, that the month that it was shut down. This didn't mean that the Fed's bailout programs were ineffective. It's just that they were effective only for certain people. The real bailout, the successful bailout, was shockingly strong and swift. This was the bailout for the people who owned assets. The owners of stock were entirely whole within about 9 months of the pandemic crash. So were the owners of corporate debt. Starting in March, when the Fed intervened, the stock market began one of the largest, fastest booms in history, with the Dow Jones Industrial Average exploding in value. The market hit its low point in mid-March when the Treasury market collapsed. But between that day and the day in the middle of June, in just 3 months, the market's values surged by 35%. In the 3 months after that, it rose by another 7%. By then, stocks were trading at the same value they had when restaurants, movie theaters, hotels, and cruise ships were operating at full capacity. The average monthly returns on leveraged loans were restored as early as April. By August, so many new investment-graded bonds were issued that the previous record set in 2017 was broken. As always, asset price inflation was portrayed in the media as a boom, And this time the boom was so intense that it was almost surreal. Millions of people were out of work. Millions more were in constant danger of being evicted. Restaurants were shuttered, and hundreds of thousands of people were dying. But the debt and equity markets were on fire. During the summer of 2020, the stock market was personified by an over-caffeinated man in his mid-40s named David Portnoy, who sat alone in a big empty room and shouted into a computer camera that live streamed his thoughts. Portnoy was one of those internet famous people who knew exactly how to capture attention and maintain it. In 2003, he had launched a free newspaper in Boston called Barstool Sports, which evolved over the years into a well-trafficked website. Barstool was richly baited to draw interest and produce outrage. One series of articles assigned the letters and grades to female teachers who got arrested for molesting students. One teacher was graded harshly with a C for not sharing explicit photos of herself. All of it kept people talking about Portnoy, and in return, he kept giving people things to talk about. In the spring and early summer of 2020, Portnoy started to talk about the stock market, launching a show called Davy Day Trader Global. He sat in front of his webcam and talked about stocks the way radio hosts talked about the baseball stats. Because stock prices were rising, then rising again. Gambling in the stock market gained an addictive edge. Portnoy took callers as he broadcast his show, including a man who apparently went by the name Balls, and who told Portnoy to buy stock in the fast food chain Shake Shack. Balls said, "Go long, I'm going long, another $500,000 on Shake Shack," Portnoy shouted during one video. Portnoy bragged about his profits and advertised the thrill of it all. Viewers who wanted to join in on the fun could do so by creating an account on the stock trading platform called Robinhood, which had been founded in 2013. Robinhood charged no fees for trading stock, enticing people to open up 10 million accounts on its platform by the end of 2019. These were average people who put their stock trades on credit cards or paid for them with home equity loans. This made Robinhood's platform look like something that democratized high finance, moving the riches of stocks from trading on Wall Street to the family living room. But Robinhood's business model was dominated by the same big players that already operated at the peak of financial power. The people who traded on Robinhood were not the company's real customers. Its real customers were big hedge funds and trading firms like Citadel Securities. Robinhood might have organized all the trading through its app, but the trades were actually executed by companies like Citadel. These firms paid Robinhood millions of dollars for the privilege because it allowed them to see what people were buying. Oh, now this is very interesting. Then make trades based on what information as they filled the order. This was called paying for order flow. Robinhood earned about $19,000 from trading firms for each dollar that a new retail investor had in their account. Robinhood's cash from order flow more than tripled from the start of 2020 to the same period in 2021. It is unclear how much money Citadel earned from the arrangements because it is privately held. Market swings were harder to predict, but Citadel had a good view into how things worked at the Federal Reserve. In 2015, the company hired Ben Bernanke to be a senior advisor. Bernanke said that he typically worked for Citadel only a few days a year. sharing his views on the economy, or occasionally showing up for client events to be interviewed. He declined to say how much he had earned for such events, but Citadel was shown to pay well. The company paid Janet Yellen $710,000 and $760,000 to give speeches in 2019 and 2020, according to financial disclosures. Firms like Citadel benefited when the trading activity became feverish, as it did in the summer of 2020. Helped along by a media personality like Portnoy. During one video, Portnoy seemed genuinely angry that some people cautioned against dumping money into the stock market. "Where are all the haters now?" he bellowed. "Now I have both hands on the steering wheel and I'm taking this thing to the moon. We're going to drive right over all the haters, and people are mad? Why are you mad? Get on board. Buy. Everybody else makes money. Everybody else makes money. Buy, buy, buy. We make money. Why the haters? Why are you shorting the market? Because you're wrong and outdated. Because I've proven you to be a fool in 2 months? Turn these machines on." They did turn the machines on. Robinhood added nearly 3 million new accounts in 2020. The insanity of all this seemed distant from the world of Jay Powell. He continued giving speeches and engaging in listening tours, which were virtual now. He testified before Congress and projected the image of a steadfast leader. Jay Powell was by and large hailed as a hero, which he's not. He definitely is not. The crisis response of 2020 marked a high point in Powell's career. He had quietly served in the background at very powerful institutions like the Treasury Department, the Carlyle Group, and the Fed, but now he was the central actor of the world's most powerful central bank. There was no political downside ever to acting aggressively at the Fed in times of distress. The Fed's balance sheet, which had been a source of worry when it was 4.5 trillion, would now grow to 7.4 trillion with no signs of stopping. The controversial programs that Ben Bernanke had employed to go below zero were now background operations, employed as standard practice. The real attention was on the new experimental actions and what might come next. Virtually no one believed that the Fed was finished. Powell's predecessors and virtually everyone else in a position of power in the world of banking, monetary policy, or governance praised him for what he did. They acknowledged that it would take years, if not decades, to unwind the actions the Fed had taken in a matter of months, but that problem would be left for tomorrow. Well, I hate to tell you, but it's already tomorrow. We're at that point. Only 5 years later. Ben Bernanke began an interview in April 2020 with an unsolicited comment. "Jay Powell has done an excellent job in a different situation," he said. Janet Yellen went further when asked about the Fed's recent actions. "I think they're heroic, and I'm really supportive, and I'm really impressed by what they did." In supporting Powell's actions, Yellen provided an expansive view of the Fed's power and its role in America. The Fed wasn't just supposed to maintain a stable money supply and be the lender of last resort to banks in times of trouble. That view was outdated, she suggested, in part because the financial system had become so dominated by hedge funds, private equity firms, or other entities that there was they were sometimes referred to as the shadow banking system. The Fed was there to back them all up in times of crisis. This is why the Fed was invented, and this is what they're doing now, Yellen said. She portrayed the coronavirus pandemic as something like a bank panic that went beyond the banks and affected the entire American economy. The Fed was now the lender of last resort for everyone. When the coronavirus came along and people realized how very serious it was going to be, there was just a huge, broad based flight from risky assets to every type, and that's like a modern day bank run. Fortunately, the banks, the core banking system, is in good shape. Again, it was centered in the shadow banking system. People are terrified of losses and they're running from lending and want to avoid um, and want to be in the safety of cash. The role of the central bank is to take risks to avoid harm to the economy when no one else is willing to do so, Yellen said. The bailout of 2020 was the largest expenditure of American public resources since World War II, solidified and entrenched an economic regime that had been quietly and steadily constructed largely by the Federal Reserve during the previous decade. The resources from this bailout went in largely to the entities that were strengthened by the policies of ZERP and QE. It went to large corporations that used borrowed money to buy out their competitors. It went to the very richest of Americans who owned the vast majority of assets. It went to the riskiest of financial spectators on Wall Street who borrowed money to build fragile positions in the market. And it went to very large U.S. banks, only the largest, whose bigness and inability to fail was now an article of faith. All of this happened at a moment when Americans were more distracted, more beleaguered, and more financially stressed than at any other moment in modern history. It was difficult to even comprehend the impact of what had happened, but the impact would make itself visible in the months, years, and likely decades to come. Well, that was the end of chapter 15, and as we know, we're 5 years now. We're in 2025. Our value of our currency is going down. If you watch the news, you're hearing every day that gold prices are hitting all-time highs because of the uncertainty and instability of the U.S. dollar. The U.S. dollar is basically paper now. It's worth less, but yet the costs of goods and services have gone up, and like it said in that last paragraph of the chapter, during the coronavirus pandemic, the people who benefited the most were the wealthiest people. And it's going to continue to head that way. And the divide is going to get only bigger and bigger in the years to come. You're either going to be on the side that have yachts or have nots. And unfortunately, if you don't learn how to make smarter financial decisions and take learning about money and about financial education seriously, you will be in the latter that have nothing. So, do what you can. Take the time. Learn about business. Learn about entrepreneurship. Learn about money. Learn about how to make it. What it is. Anything you can about it. So that way you can make better decisions financially for yourself and for your future families. Anyways, this is the end of that video. So please like and subscribe to the channel if you like the video, so we can get this out to more people.